Target stock just reported earnings and the company sold off 6% following the news. That makes it a 63% drawdown from all-time highs. Target stock is now sitting at one of its highest dividend yields in the history of the company. So why is Target stock selling off, and is it actually an opportunity to start buying? The last time the dividend yield was this high was back in 2017 after a large sell-off, and that was actually a great time to buy as the company had massive dividend growth and the stock price hit all-time highs in the following years. If you had bought then, by August 2021, you would have had a 432% total return. And even after Target's terrible stock performance in recent years, you would still have a positive 126% total return. And if we go and take a look at the full dividend history for Target stock, you can see that it's gone through periods of low dividend growth in the past. As an example, back in that 2017 period, their dividend growth was around 3% a year. However, Target had a little bit of a boom period coming out of the pandemic. And in 2021, they announced a 32% dividend increase, and in 2022 announced a 20% dividend increase. Now, the problem is that they got ahead of themselves there, and the dividend growth has slowed down massively, while Target has also been through a lot of trouble in recent years in terms of business performance, brand image, and stock price. Since then, the company has been growing their dividend just under 2% a year. This brings the 10-year compound annual growth rate of the dividend for Target stock at 8.17%. So why did the dividend growth slow, and why is the stock price performance so bad in recent years? Well, coming out of the pandemic retail boom, Target's earnings completely fell off a cliff, and they really have not recovered to those highs since. After a huge fall off in 2022, they rebounded going into 2023. However, they've been declining in 2024 and 2025. And currently, analysts are projecting negative 16.4% earnings per share growth for this fiscal year. So obviously, not ideal. However, this could create opportunity for the long-term investor if Target's able to turn it around. So today I'm going to give my thoughts on Target stock and an updated stock analysis. That will include a look into their latest earnings call, what the news is around the company, and then I'll also discuss what the guidance is for the upcoming quarters and year. Finally, I'll give my thoughts on fair value for Target stock and whether or not it might be a buy right now. With that said, let's roll the intro and get into this Target stock analysis. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Throughout, I will be using dividenddata.com, which in my opinion is the best stock research tool, especially if you're a dividend-focused investor. Here you can access a full financial history of a company, including all of their dividend payments and the individual growth rates, as well as metrics around dividend safety and all the financials in the stock. And you can also track your dividend portfolio as I do. Many of you have been following my monthly stock portfolio updates for years now, and it gives you a great look at your projected dividend income of your portfolio. And we just put out a huge update to dividenddata.com that expanded our research from 8,000 to over 80,000 stocks. So you can now search international stocks like LVMH as an example, and ETFs and mutual funds like SCHD right here. And we have this custom view for ETFs and mutual funds so that you can see important things like the expense ratio and all of the holdings in the company. And of course, it wouldn't be Dividend Data without the full dividend history and growth rates. If you want to follow along, this is all available at dividenddata.com. But now let's get into that Target stock analysis. We'll start with the earnings call as they just reported their Q2 earnings on Wednesday, August 20th. And the key news here is that the board just elected a new CEO, Michael Fidelki, and that'll be effective at the start of 2026. Brian Cornell, the current CEO, will be stepping down from the company. So this definitely could be part of the reason why the stock was down. It was already not doing well, and now there's new uncertainty introduced into the story. On the earnings call, he outlined 3 key priorities. That's to recapture Target's merchandising authority, improve the guest experience in stores and online, and leverage technology to improve speed, efficiency, and guest experience. And to be honest, those seem like pretty basic things. It's not really newsworthy. For investors, I would say the most notable thing on the call was that they gave guidance for the full year. They reaffirmed their full year guidance of low single-digit decline in comparable store sales and adjusted EPS in the range of $7 to $9. And as I mentioned earlier, from the analyst estimates for earnings per share, that's coming in at $7.28, which is on the low end of that guidance from Target. And if they hit that, that means Target is trading at a 13.5 PE ratio based on today's prices. And in today's high-flying market, that's definitely on the cheap end, especially when you consider that's after an earnings decline, and analysts are projecting single-digit earnings per share growth in the years coming after that. As an example, by 2030, they're expecting $9.59 in annual earnings per share, which would mean Target's trading at a 10.2 P ratio. So I'll give you some of my initial thoughts here with Target. I would not rush into buying this stock right now. I think it will probably remain cheap for a while. It's going to be a couple quarters before it starts turning around. But you should definitely have this on your watch list if you're a dividend-focused investor. This could be a decent retirement income play. Target is a dividend aristocrat with over 25 years of consecutive annual dividend increases. It may actually even be a dividend king, which means it has over 50 consecutive years. And I would not say this dividend is at risk of being cut. Based on last year's earnings and free cash flow, the dividend payment was very sustainable. Free cash flow payout ratio is 45%, and the earnings per share payout ratio is 50%. Now, obviously, this will be worse in this fiscal year, and we can do some back-of-the-envelope math. The forward-looking annual dividend payment is $4.56, and the company gave guidance of earnings per share from $7 to $9. So let's just be conservative and say it's $7. That gives it about a 65% dividend payout ratio. So I don't think there's risk of a dividend cut over at Target. The bigger risk is that I don't see any catalyst for acceleration in dividend growth. You're probably going to stay at this 2% dividend growth range for a while. And when I'm looking at investments, I always think about opportunity costs, so weighing it against all the other potential things you could buy at any time. And I could think of quite a few investments that would be better than Target right now. However, to be fair, if we went back to 2017, when it had low dividend growth and the stock price was down, and that was the other time that I was at that peak 4.6, 4.8 dividend yield range, you would probably have said then that you don't think the dividend growth will accelerate. But it did, and the company had great returns in the following years. The stock price even boomed to all-time highs. But, and this is a big but with analyzing the stock, the earnings per share at that time may have been an outlier to the upside. There are some companies that did well during that COVID boom that have still not hit those highs. As an example, even Kroger, a company which is doing far better than Target right now, their earnings per share has been kind of flat over the past couple of years. So is Target a buy or sell? Well, I'll give you the analyst price targets and buy ratings, and then I'll do a couple valuation methods on the company, including discounted cash flow, and probably the dividend discount model as well. If you stick around to the end, I'll give my thoughts about investing in Target stock. As you can see, the current consensus price target among Wall Street analysts is $127. That implies the stock is 28.77% undervalued at the current price. So there's 28% upside. The lowest price target on Wall Street is $94. So the stock is nearly trading at the lowest price. And in terms of analyst grades, it's basically split right now. We have 49% at a buy rating, 25% at a hold, and 7% at a sell rating. All right, so now I'm going to do a discount cash flow analysis on the company. I'll be using the DCF calculator in the AI Analyst on dividenddata.com. Just type in any stock, as an example, TGT, and DCF calculator. Scroll down and you can open up this calculator and edit all the assumptions you need. And I'll give you a couple different versions of valuations here, both from a very conservative angle and then a more aggressive take. So on the conservative side, I'm basically projecting around 2.5% revenue growth, 2027 through 2030, and free cash flow taking a hit this fiscal year, then rebounding to about $3 billion a year, going up to $3.4 billion a year. And for this example, I'm using a perpetuity approach with a terminal growth rate of 2.5%. And that gives the company an implied share price of $90.09, which actually implies 8% downside from here. Now, I would say this is definitely on the conservative end of valuing Target stock. So let's do a little bit more of an aggressive version. Now, we have to keep in mind Target's not a high growth company, but it has produced far more cash flow in the past. Even last year, they produced $4.4 billion of free cash flow. And during 2021, that was as high as $7.8 billion. So I edited some of the assumptions in this DCF calculator, and I had it only dropping to $2.7 billion of free cash flow and ramping back up to $4 billion a year by 2030. And that gives Target an implied share price of $112, implying 13.8% upside from here. Now let's do an even more conservative valuation method, which is the dividend discount model. It's similar to a DCF, but instead we're projecting the company based on all of the future dividends it will pay you. So I filled in all the data for Target, and I'm assuming here a 3% dividend growth rate going forward. That would be annualized. And we're using basically a discount rate of 10% as the expectation. And with that, we get a present value for Target stock at $64.59. So that's not very good. Even if we assume annual dividend growth of 5%, we're still not getting close to that current stock price. Now, to be fair, that's a very strict valuation method that I typically only use for high yield dividend stocks, where I expect the dividend to be the core part of the return. Target stock's not really in that category. Historically, this company trades in a 2 to 3% dividend yield, and we're actually at quite a historical outlier period right now. And over a multi-decade view, I'm sure Target will continue to be a dividend grower and be a stock that compounds in the market. But as Target hits these new lows in stock price, I'm not really enthused to buy in yet. For my personal situation, I have many other opportunities that I find more attractive in the market. That said, I like Target stock a hell of a lot more when it sells off 6% a day. And if it continues to get beaten down, this is definitely a good opportunity, especially for anyone who just wants a reliable dividend stock in their portfolio that's probably not going to cut their dividend and slowly will grow it over time. In terms of yield, this is a good entry point for Target stock. If you enjoyed the video, please leave a like, comment, and subscribe to the channel. And if you want to use the tool I showed throughout, all of this is available at dividenddata.com. The link is in the description and pinned comment of the video. With that said, thanks for watching, and I'll see you in the next one.